What's going on, everybody? Today we're going to be looking at a whole different range of different things. First, we're going to be looking at technical analysis with the SPY. I'll describe what that is if you don't know. From there, we're going to go into like different indicators or possibilities of why there might be a recession coming in the future. And from there, we're going to talk about different paths or what's the most likely scenario that we would see if we were to get a recession first before we actually die in the markets, in all markets, really. Okay, so I have a line chart just because it's easier to see, but these lines that I drew, they were based off of candles, sticks. They're a little bit harder to read, and I have videos describing on how to read these, but I'll go ahead and leave it as a line chart just because it's easier to read or to look at. So the SPY is the S&P 500, top 500 companies weighted by market cap, which is basically, in order to calculate market cap, what you do is you multiply the shares versus the stock price, and from there, it'll give you your market cap. There's 11 different sectors. I'm not going to look at all of them, but I just kind of want to show you what they are. So you got energy, you got stuff like materials, you got stuff like consumer staples like Costco, Walmart. You got financials like the banks, BlackRock, JP Morgan, and stuff like that. All of them have a different weighting within the S&P 500. So these are some different levels that I've been looking at. I had similar levels for last week in the market analysis videos talking about like what could possibly happen. We basically chopped around the whole week. We didn't really go anywhere. We just stayed stuck in between the 443 and 436 level. We actually fell down over the weekend. So that's actually, and that first day of the last week. So it's not too good. But the possibility that it is forming is an inverse head and shoulders over a longer period of time. And the longer period of time, the more valid technical analysis. And basically what you do is you just measure the bottom move, shoulder, measure that out. What is our price target? 484, excuse me, by this measurement. But I don't do that. I just go to the neckline just because, all that up there is not guaranteed. Not only that, but we're really news driven at the moment. If something news comes out about Russia, Ukraine, even if it's not even like detrimental, it'll swing us one way or the other, up or down. The Fed with raising interest rates is driving the market crazy. There's just a whole bunch of different news that has caused us to go different ways. Here, I'm gonna put candles first, just because it's kind of for now, just because it's a little easier for me to read. I forgot not if I forgot how to read a line chart, but I forgot how hard it is to read it once you go to candles. So this area is whenever the Fed was talking about interest rates coming sooner than expected. They were supposed to happen in summertime, but then ended up saying it's gonna be March. Here they confirmed it, and what happened since then? Systematic downturn, man. Also, Russia-Ukraine's tensions started boiling, and eventually we had the declaration of war of Russia on Ukraine. We gapped down insanely. This is a $10 gap down, $12 gap down, because the red candles at the close of the day is at the bottom, the green candles the close of the day is at the top, but they opened down here. So over the weekend, boom, down. And this is whenever the Fed was talking about what they're going to end up doing in May when it comes to running off their balance sheet. There's no reason this should have happened, but it did happen on low volume. We eventually got to pull back. Where do we go now? It's pretty uncertain. But shorter terms, like the next couple months, I feel it was going to be bullish. We're going to be going up. And I'll describe later in the video why I believe that. All right, let's go ahead and go into recessions. So, you can kind of look up when recessions happened. At any really website, I looked up this one just real quick, just kind of gives me a brief description of each recession. So just because I'm aware, that way I'm aware of what recessions have happened so far. I just want to make sure this chart was up to date. I won't say up to date, but it was correct whenever it was talking about the recessions. All right, so something that people have been talking about recently is the yield curve inversion. Basically, banks lend out money at the 10-year or the 30-year, 15-year, the longer time frame bond rates. They base their interest rates off of that. Not only that, but they borrow money at the two-year, the shorter time frame, what's it called, interest rates. So if the yield, which is basically the percentage of your year-over-year return you get on a bond, is lower the longer time frame, but higher in the shorter time frame, it's hinting that something bad's coming in the near term. Is it going to happen? Maybe, maybe not. But this chart shows you what it's the 10-year yield minus the 2-year yield, and each time it's gone below zero, which means that the 2 years is larger than the 10-year. We've had a recession pretty close after that. Sometimes it takes months, 17 months, 9 months, 19 months, 13 months, 23 months. But eventually something comes in the future, and this is people have used this as an indicator of a leading indicator, basically letting you know in advance what could possibly come in the future. And we could actually look at it here on this chart. I kind of plotted out whenever it did invert, what days that was. And we kind of see what ended up happening shortly afterwards was the recessions. 2000. Technically it inverted to 98, but if you want to be a hard inversion, which is basically whenever it's under zero for a prolonged period of time, that one happened early 2000, late 99. What happened shortly after that? Dot-com bubble. Happened shortly after 2006, housing crash. What happened shortly after 2019? COVID, the pandemic. It didn't necessarily predict COVID was going to happen, but there was already something wrong with the economy. So a recession or a bear market was bound to come. COVID just made it happen faster than expected. And recently, in late April, early March, we had a yield inversion as well. So are we going to get something? Maybe, maybe not. You can't put all your faith in one thing. And something else to look at is this chart is basically the same chart we just looked at right here. Which is the same chart we looked at right here, but this time I have the SPX, which is the S&P 500, what we looked at first. I have that on top. So I also marked off when the yield inversion happened. So you kind of see all these three charts basically lined up together. So what we can see is this 10-year, the longer term bond, the interest rate on that, fall, but we can still see the markets rise. So recently, let me go and delete this because this is kind of getting annoying in the way. So we see this crazy upwards movement, and usually what happens after crazy upward movements, we fall. Crazy upward movement, fall. Let's look for some more. Crazy upward movement, fall. Crazy upward movement, fall. But that doesn't necessarily mean the markets have to fall. If you look at this right before the pandemic, we saw this move upwards and we saw this dramatic fall down. Initially the markets took that bad here, but what ended up happening here after they continued to fall again, the market still went up for another, what is that, from August 2019 all the way up to March, February-ish of 2020, 6-9 months, it continued to rally. And eventually the pandemic happened, which what the yield inversion was hinting at. Even and if we look at other times, it doesn't necessarily as clear just because nothing ever plays out really the same. So if you look at whenever the yield inverted in 2006, January 9th, bonds continued to rise. And if you look at the peak of the bonds, this was the bottom of a little pullback we had in the market, but we continued to rally. And eventually when it fell off, we were still up for a bit. This is the second peak. We still eventually saw a new high after this yield inversion had happened and after the bonds had fallen. We still saw a high in the market. So we'll also look back at 2000. I consider soft inversions okay, in my opinion. But also, if you want to be strictly speaking about it, you want to know for sure. A hard inversion would be the one you want to look at, which is probably this one. But if you look at what happened on, if you look at the chart down here on bonds, you see this sharp decline off the hill. What ended up happening shortly after? We had a peak. Eventually we came down. Don't get me wrong. That's not good. But after this little drop that we had, we continued to rally. And what ended up happening again after we sharply fell off a cliff, we still put in a new high here and then eventually here as well. So, we can still go higher in the markets. And just to put this in perspective, let me see what type of drop this is. What percent gain this is. Isn't that great of the greatest return? But that's a 15% move after the yield inversion had happened. And we look again. What's another time this happened? 88. Whenever the yield inversion happened, shortly after we had it fall off a cliff. And if we look at where this lines up, this lines up with the bottom right here. And if we were to measure the move that happened from there to the top before we actually had the recession, we had a 30% rally. And then eventually we had this fall off a cliff type moment with the market as well. But it just shows you that there could still be rallies even though there is a yield inversion, and we could still go. Sorry, I don't know what the hell I did. Alright, well, we're going to move on to the next thing. The next thing I want to talk about is sector rotation theory. Basically, market cycles and economic cycles are two different things. That's basically what they like to say. Basically, the economy is what drives the markets, but the markets come before the economy. So if you think about it, think about COVID. When COVID happened, the market took off shortly afterwards. It only took 4 weeks. So if we go back to where COVID happened, it really only took like 4 or 5 weeks. So from February all the way into the end of March, 4 weeks for it to experience all its downturn, and then from there we had like an economic boom ever since then. But we didn't get over the pandemic in our economy. We're still even, I won't say struggling, but struggling even today. The economy is still not as strong as it was before the pandemic, but the market is definitely higher than it ever was before. And it didn't take us very long in order to get there. It took us to August of 2020 in order to get to the all-time highs once again. That just shows you the markets precede the economy, but the economy is the one that caused the markets to have this type of thing happen. Like I mentioned before, there's problems in the economy before COVID happened. COVID was just an excuse to be able for the markets to die, and markets to get their pullback, which was long overdue and expected, basically. So what happens during these times? There's different things that do happen. When we're at the market bottom, technology, consumer discretionary, which is basically stuff like wants, not necessarily needs, are the best buying opportunity. You ride them up into the top of the market cycle, and when you try to sell somewhere at the top, if you just want to play these, then you just wait for the next market bottom. From there, you'd ride it up to the top, and you sell up here. But money flows into technology because this is the best buying opportunity at the market bottom, and it rotates into the next sectors, and into the next sectors, into the next sectors, into the next sectors. So if we are going to see a top here in the future, or if we have experienced a top in the future, energy, materials, consumer staples, that would probably be the ones that are performing the best. And within the SPY, and remember, like I said, the SPY is made up of these different sectors. So what has been performing the best? On a 3 months relative basis, energy, utilities, basic materials. What do we say? Energy, utilities, basic materials. This is either at the top or this is slightly into the bear market. And what have we experienced? We already experienced the top. We're slightly into a downturn. If we do see another top, that would make sense. But if we start seeing lower lows and continue to fall, it makes sense as well. Not only that, but we look at it on a longer term basis, on a 3 month basis. What has performed the best? Energy, utilities, basic materials. Same thing, that's kind of how it was up here in consumer defensive. Energy, materials, consumer staples, and utilities. Our money's flowing this way. So are we going to be hitting our economic cycle here at the top and then eventually hit this recession? Possibly. Not only that, but healthcare. Healthcare is underperforming at the moment, and the theory that I have behind that is that since COVID happened, and COVID was the reason why we had our quote-unquote recession, that's why this is underperforming. Because this whole time when they're developing a vaccine, healthcare was having the time of its life with the stocks. So if we go back over here and we look at, let's say, Pfizer. Oops, okay, I forgot the ticker. Moderna. Look at Moderna. mRNA. What happened during COVID? It had the craziest rally ever. And even though it wasn't its time to be performing, or I'm not going to say it shouldn't be performing, all the healthcare stocks were having crazy runs. And now what's happening? They're still underperforming. Where's healthcare at? Healthcare is close to the top, but it's not necessarily up there where it should be. So what's my theory on that? Again, healthcare stocks, these medical stocks have already had their rallies. They're not going to be that much of a performer whenever it comes to this market cycle theory. Just because our recession was a byproduct of that. Another thing I've been looking at is the junk bond for the TLT. So you can actually look what junk bonds are and see what they actually hold on the Yahoo Finance website. They kind of go into the breakdowns of what each is. Basically, junk bonds are risk-on assets. Whenever the market's in an upturn, you want to be able to take on that risk because the reward is better and it's more, I won't say safe because nothing really is ever safe, but it's more safer to do it in that time than an economic downturn. What happens whenever we're in an economic downturn. You know, the markets are going down. You want to put your money somewhere safe. So what do you put it in? You want to put it in bonds, treasury bonds specifically. You know, government issued bonds. Junk bonds are issued by companies, not the government. And this basically shows a relationship between the two. When we see these up cycles, these upticks, you know, that's whenever we have our bull markets. You know, we're expecting the market to go up. Whenever it hits this resistance and falls down, that's when we expect bad things to happen. And it's basically the ratio between junk bonds and TLT. Junk bonds in 20-year plus treasuries bonds. Now currently we're hitting this point of resistance. Technically we have broken the trend, but you know, are we gonna fall again? If we do, that would be another hint or another signal that basically a recession could be happening, or a pullback of some sort. Maybe it's not gonna be no housing crash, maybe not no .com bubble, but maybe it might be something a little bit more mild. You know, I'm not saying that the world's gonna end either. Another thing to keep in mind is consumer spending. You know, the CNBC did a survey. Not only that, but the government also does what's called surveys as well. I forgot what the data's referred to as. Somewhere over here, I think it's consumer spending. They have like PCE. There you go. They actually have data that they release as well. But basically, they did a survey asking U.S. residents, you know, what do your spending habits look like? You know, what are you more likely to do? So like, if prices persist, you know, what likely are you going to cut back on? Dining, driving are the main two. They had some other questions, like, what have you done in the past 6 months because of higher prices? Cut back on dining, cut back on driving. What caused the most financial stress? Gas prices, housing, rent. I forgot the statistic. I actually had some written down. I was listening to a podcast not too long ago. But they're saying rent year over year went up 13, 14%, 4%, 0.4% month over month for the March data that was released in April. So, you know, it's showing you that the consumers don't really want to be spending that much money anymore. And what drives the economy? The flow of money, the rotation of money between hands. You know, from consumer to the producer to the supplier. You know, all that money needs to be flowing. And if consumers aren't spending money, producers aren't making money, they're gonna not really order anything from suppliers, and the suppliers aren't making money. They're gonna start it's just the flow of money, and everything relies on the consumer. Everything relies on the producer. Everything relies on the supplier. And we're not getting that. You know, if anything, we probably see more economic slowdown, which isn't good. And that kind of leads us to the next thing I want to talk about. I want to talk about jobless claims as well as unemployment rate. You know, we're already back at levels that had happened pre-COVID. And even then, before then, you know, when was the last time we had these levels of unemployment? You know, that was back in 1970s, 1950s, and early 50s as well. You know, we haven't had these type of levels of unemployment. And what normally happens when we hit those bottoms, boom, unemployment ends up rising again because we reach full employment at that time, which is good. It's showing that our economy is strong, you know, but we go through strong booms and bust cycles, you know. So is this time for a bust cycle? Because as you can see, you know, normally we don't last in these levels. You know, here we kind of lasted there. You know, how long was this for? This was what is that? I can't really see. Let me zoom in. Sorry. I'll just say from here to here. That's about 3 years that we survived in that range, you know. And this is all back then, you know. Recently, have we ever had something like that? No, we normally have little dips. Never really prolonged periods of time at these levels, at these rates. You know, jobless claims. You know, we've had some crazy downward movement. Not only that, but we've been sustaining this. The reason why a lot of I believe that this is going on is because companies, they don't really want to let anyone go. You know, they know how hard it is in order to get people to fill their slots. One, because there's not as many people that are trying to enter the markets, but two, lack of supply of workers. You know, and it's been a problem. You know, and they can't really afford it for that to happen. So, again, once again, you know, we're at our lowest points. You know, is this our breaking point? Possibly. Another thing is the Consumer Confidence Index. And once again, you can kind of look in to see what this is and the stuff is that I'm talking about. You know, right here, this is what it's saying. The Consumer Confidence Index is a survey that indicates how optimistic or pessimistic consumers are regarding to their financial situation. We're at lower levels than we were during the lockdowns. We're at lower level. We're low levels, like kind of like when the 2011 financial crisis, the European financial crisis, or the housing market crash. You know, we're at those levels. We've reached those levels recently. That's not good. That's not good. You know, we are going up now, but if we do visit prices, not prices, levels like that again and sustain levels, you know, that's not good whatsoever. Alrighty. So now that we look at that, you know, what's some possible things that could happen if we were to have a recession before then? You know, as we look at the charts, you know, normally we don't go down first. What ends up happening is that we end up having our last leg up. So it takes me back to what we were talking about earlier, technical analysis. Um, Again, inverse head and shoulders could be going up from here. So what's realistic? For me, what's realistic is to hit all-time highs again. I don't necessarily want to be risky and see what's next up here. You know, I might leave a few, like a certain portion, maybe like 25% of my holdings at the moment, in, you know, just to get that little exposure to the upside potential. But I really don't want to be flirting with this stuff because, you know, we never know when all of a sudden we're gonna die. It could be a news event, kind of like how the pandemic happened, or it could be a slow decline, or a mid kind of decline, kind of like how we had right here. I don't want to be in the markets when that happens. So I'm just gonna play to all-time highs again, and I'm gonna kind of wait. It's a good idea, maybe not, you know. But again, once we find a level that we can bounce off of, and we see lots of volume, kind of like how we saw here, but to the upside or not to the downside, we definitely could see some nice movements. And I'm positioning myself in a way that that I could have some exposure to that. So I looked at things that could fuel this rally. You know, there's one of these people that I follow is Game of Trades. They pointed out this PMI, which is the Purchasing Managers Index. You can, once again, you could look up this and see what it is. But basically, when it peaks out, normally a year later, inflation peaks out, and they peaked out in May of 2021. Or could we peak out in May of 2022? And the May 2022, that the release of that data would happen the following month. So what is that? May, June, the June release, and that's going to be fuel for the markets. The market sees that inflation's coming down. They're like, oh, the Fed's doing their job. Great, you know, boom. That's fuel right there. Not only that, but Biden with allowing us to tap into fuel reserves and possibly even letting us go drill for oil once again. That'll bring energy prices down, and that's one of the main drivers in our CPI data or inflation data that we've been getting each month. Energy, and also what's called food. But we can't really control too much of the food part, just because it's easier to produce oil than it is to produce food. Just because food's seasonal and takes time. I'm sorry, guys. There was one thing I forgot to mention, and it was basically the Fed, their plans for the rest of the year. On top of that, what the market has already priced in. So what ends up happening is that news doesn't actually affect the markets. It's anticipation of the news that affects the markets. So the market has priced in 6 more rate hikes on top of the one in March. That's 7 total for the 2022 fiscal year. So that, not only that, but they're pricing in the next two rate hikes to be a 50-point basis rate hike. And usually the Fed doesn't want to surprise markets negatively or positively, but Federal Chairman Jerome Powell, he's more conservative than most chairmen that have served on the board. He's really conservative, slow going. He's not going to rush into anything if it feels like it's going to scare the markets. So we might actually get a 0.25% rate hike instead of the 50 basis point rate hikes that we were expecting for the next two. Not only that, but we might even miss one of the rate hikes in anticipation. I mean, in the future, that is. And both of those scenarios is definitely bullish for the markets. It's going to fuel the flames and help us with this last leg up. You know, we don't know what's going to happen in the future. You know, that might not happen, but just based off of the past things that the federal chairmen have done, on top of that, our current chairman has done, it's very much a possibility, unlikely to happen as well. This is something we're kind of looking at earlier when we were looking at the junk bonds, and we're also looking at the, oh damn, I deleted it. We were looking at the 10-year yield as well as the S&P 500. Yeah, we've already looked at that. When we're talking about that, basically saying that just because it could fall off doesn't mean that the market can't rally some more, and just because it does show that we're on risk off scenario, which is basically this back part you can't really see. Just because it's going down doesn't mean that the market can't go up, which we've experienced in the past. It's definitely something to see. Just showing you that anything is really possible at this moment. Another thing to watch is the DXY, which is the dollar index, basically the strength of the US dollar versus different currencies. And right now, we're approaching resistance. Resistance with this trend line, and if we break out past that, this 102, 103 level that has proven to be resistance in the past. From a technical analysis standpoint, this could be a triple top because it already double topped right here and fell. Now, if we come here and fall again, that's a triple top, which is really bearish. And the times whenever we see this weakening of the US dollar, we see the value of our stocks, the value of our crypto, the value of our houses go up in price. And whenever we see the rises, we'll see normally a decline, which is that's if everything was to stay the same. You know, there's a whole bunch of different moving price a whole bunch of moving things that relate to the price of different things, of equities and assets. So you can't just follow this, but if we do fall, you know, it'd be pretty nice because the value, once again, of our stocks, of our assets will rise in price. An indicator that I like to look at is the NDTH. So this is for technology. Basically, which ones of them are above their 200-day moving average. And moving average is basically, you know, if you were to average the past 100 days, 200 days in this case, and plot it on the chart, you know, this kind of gives you a percentage basically of how many are above that 200-day or below the 200-day. And normally whenever we're in this range down here, it signals a bottom, a good buying opportunity. And if you were to buy here, you know, you might be able to see some potential upside, some potential green. And in past times, whenever there was some type of crisis going on, you know, you could see this dip into the area and go up to the top of the range and eventually come back down. And I'm not saying I suspect something like that would happen, but I would suspect something like that would happen. You know, we dip to the bottom of the range, come up here, possibly even tap it, and come right back down whenever it does come time for a recession. Not only that, but share buybacks by companies. You know, companies, when they do share buybacks, it's normally because they're bullish on their company. You know, they see the value of it as could potentially go up, and if that was to happen, they want in on it. So that's why they'll buy from you, because the value of your stock is attractive in their minds, you know, the price of it. So they'll buy it back for you. And from there, what's called it could boost the price, and they could profit off of basically upward movement in the future. They also could just do it to make it look mildly more attractive to investors, because if investors don't have as much stock that they could buy anymore, the value of it goes up. So if they that's just law of supply and demand basically. And you know, it could be either or. You know, it could be because they're trying to make their stock look attractive at a time of downturn, or it could be that they know something that could happen in the future and they're bullish. This isn't necessarily an indicator, but this is something that someone I've been following on crypto. His name is Benjamin COWEN. He's the most unbiased person when it comes to crypto, because if you look at crypto videos, most of them have like, oh, 10x gains here, 100x gains here, you know, oh my god, the world's ending or something like that. And him, he's just, he has a mathematical background. I think it's physics and math as well. And what he does is he basically tries to build models for Bitcoin. And right now he has one. It's the BTC, logarithmic regression bands, and basically they help visualize and see, you know, where we are at in the cycle. You know, are we close to the top? Are we close to the bottom? Right, currently we're in no man's land. So it does show a lot of potential for upside potential, basically. And eventually, if we were to hit a recession, we'd probably be in this green territory, which is normally the accumulation time of a lifetime. You know, there's some other things that I don't know. There's a lot of things that I don't know. And I don't know how the market will play out. If there's any reasons that you feel like that we wouldn't have a recession, let me know, because I'm trying to find counter arguments to my thesis and what I've been talking about so far. You know, I don't think I'm 100% right, and I want to be aware of stuff that that could possibly happen that could bring us into a downturn. I think it's important just to financially prepare yourself for either one. Not be fully invested in the market, have some cash on hand in the event that something does happen in the near term. if we do get this rally, you know, learn when to take profits, because eventually, you know, we're gonna get that pullback and that recession that people have been talking about. You know, just be prepared for any situation. That way you don't get fucked, and that way, you know, your emotions don't lead you to make bad decisions, because that's the number one thing that'll screw you over when it comes to stocks and crypto. Well, appreciate you guys. Hopefully y'all have a good one. This last thing that I do want to talk about right before we do go is that basically during the pandemic, budgeting, saving has been crazy in the United States. I don't know how this will play an effect into this whole situation, but we definitely got money on hand. Like, I guess you say, like, I won't say everybody, but per person, you know, most people have savings. Not most people. People have more savings now than they have in the past, like before COVID. So that's something else to keep in mind when it comes to the recession. Alrighty, I'll catch y'all later. Have a good one. Peace.